Today's move in SoFi wasn't random. It was a structured reaction to volume, positioning, and a market preparing for critical data. Hello, everyone. Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell. But before that, this video is for educational purposes only. It is not financial advice. Always do your own research before making any investment decisions. SoFi actually delivered a strong and well-balanced session overall. The stock managed to climb by roughly 2.5%, setting a high near the upper 28 range and finding its low in the mid-26s before stabilizing. What makes this move important isn't just the percentage gain, but the context around it. Over the last few sessions, the market has repeatedly offered similar price zones, and once again, it gave participants another chance to step in around those same levels. Anyone who was waiting patiently instead of chasing had an opportunity handed to them again, and that's not something that happens often in trending names. Volume was another key piece of the puzzle. More than 50 million shares changed hands, which immediately tells us this wasn't a quiet, retail-driven move. This kind of activity usually points to larger players being involved, and that's exactly what we saw throughout the session. For most of the day, institutional participation leaned heavily toward accumulation. Large orders kept flowing in, pushing the price steadily higher and supporting the overall structure of the move. However, the tone subtly shifted as the session moved closer to the end. Toward the later part of the day, some hesitation started to appear. This wasn't panic selling, but it was noticeable enough to matter. To understand why that happened, you have to zoom out and look at the broader market environment rather than SoFi alone. The wider market was reacting to a batch of economic data that came in slightly off expectations. Challenger job cuts were far lower than forecast, which on paper looks positive, but markets don't always celebrate strong data. When numbers come in too strong, it can reduce the likelihood of policy easing, and that tends to make investors uneasy. Initial jobless claims landed just above projections, while consumer credit growth came in noticeably lower than expected. None of these readings were disastrous, but taken together, they created uncertainty rather than clarity. As a result, expectations around upcoming rate decisions shifted slightly. The probability of a small rate cut at the next meeting nudged higher, but not enough to give markets confidence. This puts everyone in a waiting mode. The reason that late-day selling showed up wasn't because something broke, it was because tomorrow's data carries serious weight. When markets are facing a cluster of high-impact reports, institutions often reduce exposure temporarily, lock in profits, and reassess once the numbers are out. And tomorrow's lineup is exactly the kind that forces caution. Inflation-related sentiment readings, housing indicators like building permits and housing starts, and labor data including payrolls and unemployment figures are all hitting at once. That combination covers nearly everything policymakers care about. It's also the first time in a while that labor data reflects a full, uninterrupted reporting period, which makes it even more meaningful. This is why so many large players chose to trim positions heading into the close rather than gamble overnight. From a company-specific perspective, it's worth noting that nothing materially new came out from SoFi itself. There were no fresh filings, no surprise announcements, and no new analyst updates after a recent wave of ratings earlier in the week. Despite that, one interesting data point did surface related to digital activity. Historically, there's been a strong relationship between SoFi's online traffic and its member growth. Recent data suggests activity levels are already tracking above prior months, which hints at continued momentum. While some of this could be tied to loan-related interest, the broader implication is that engagement remains strong and member additions could once again surprise to the upside. Short interest also crept higher, but only modestly. A few 100,000 additional shares were added to short positions, continuing a gradual trend that's been developing since late December. Compared to earlier periods when short activity swung wildly by millions of shares in a single day, this behavior looks far more controlled. Roughly 10% of the float remains shorted, which is elevated but not extreme. The previous imbalance issues that raised eyebrows earlier have largely resolved, leaving only one questionable metric: a negative minimum borrow cost. That suggests some brokers may be incentivizing short positions, which is unusual but not unheard of in heavily watched names. Options activity leaned bullish overall. Call volume significantly outweighed puts, with net premiums increasing by several $million. Nearly 50% of all options traded favored upward movement, showing that a sizable portion of traders are positioning for continuation rather than reversal. From a directional standpoint, bullish expectations cluster in the upper 27 to low 28 range in the very near term, while more cautious views see consolidation back toward the mid-26 if data disappoints. Open interest levels remain manageable, with notable concentrations around the 27, 27.5, and 28 strikes. If the stock were to push decisively beyond these zones, especially toward the high 28s, it could introduce additional momentum as hedging dynamics shift. That scenario wouldn't guarantee anything dramatic, but it would add fuel to an already active setup. Looking at larger trades executed throughout the day, several multi-million-dollar transactions stood out. When these are organized by timing rather than size, a clear pattern emerges. Early and mid-session activity leaned heavily toward buying, supporting the upward move. As the day progressed and uncertainty around upcoming data grew, selling activity increased, particularly near the close and into after-hours trading. This shift aligns perfectly with the idea of profit-taking rather than loss of confidence. Technically, the close landed right between key reference levels, establishing nearby support zones just below current prices and resistance slightly above. The stock managed to hold above shorter-term and longer-term moving averages while failing to fully reclaim a critical mid-range average. That rejection matters, but so does the fact that price remains close enough to attempt another test if conditions improve. For growth-oriented names like SoFi, reclaiming that mid-term average often acts as a signal that momentum is returning in a more sustainable way. So where does that leave us? Despite some late-session caution, the overall structure remains constructive. Institutions showed clear interest earlier in the day, volume confirmed participation, and the stock held important levels despite broader market uncertainty. Everything now hinges on how the next wave of economic data is interpreted. Strong alignment with expectations could open the door for another push higher, while surprises may temporarily drag prices back into familiar ranges. The bigger takeaway is simple. Today wasn't about news, hype, or surface-level movement. It was about positioning ahead of a critical moment for the market as a whole. Whether you added, held, or trimmed, the key is understanding why the stock behaved the way it did, because that context matters far more than a one green or red candle. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.